about Japanese yen carry trade. So let's pull us back to last August of what happened. Okay, I have explained this. There are videos, by the way. If you guys don't understand it, please go check out those videos. Go to the channel, do a search under Japanese yen carry trade. I've done three videos clearly explaining what it is. So I'll go through it real quickly again for the people who are new to the channel and asking the question. There is a different version of Japanese yen carry trade going on, and it's draining liquidity from the global markets, from crypto as well as stocks, and how it may affect everything else that's coming up. So the original Japanese yen carry trade crisis was, or the history of Japanese yen carry trade is that Japan was in a deflationary cycle for decades. And in order to come out of this deflationary cycle, they had lowered their interest rates below zero, literally below zero. So what happened? Well, what happened is that a lot of institutions leveraging everything, or specifically hedge funds, they went and borrowed in Japan, okay, at zero interest rates. And then they came back to the US, either invested in stocks or invested in bonds, right? So we had a time when we were hiking interest rates coming out of the pandemic because inflation genie got out of the box. We were trying to put that in the box. Well, we're never going to do that now. But the main point is, if I'm a hedge fund, if I leverage this trade by 5, 8, 10, 20x, I can literally go borrow in Japan at zero cost, zero interest rate. Okay, so Japan became the creditor of the world. And then what did I do? I turned around and brought the funds back. So now there is the currency part of this, which I'm going to try to explain as well, how the Japanese yen carry trade unwind happened last August. Not last August, August of 2024. Is that we, as a hedge fund, let's say I'm a hedge fund, I go borrow in Japan at zero interest rates, except that when I do borrow in Japan, I can borrow with Japanese yen. So what do I have to do? I have to convert my US dollars to Japanese yen and then borrow at zero interest rates. Okay, so I borrowed it, I levered it 5, 8, 10x, and then I turned around and brought it. I took that money and then started buying US Treasuries. So the difference was, in Japan, interest rates were zero. In the US, they were 4 on the same duration bonds. Okay, automatic 4%, lever it up 10x, everything is wonderful, right? Okay. Then what happened though? The Japanese government, because Japanese government debt to GDP ratio is like 200+%, right? They have pumped so much money for them to come out of the deflationary period. By the way, deflation is probably worse than inflation. So in order to come out of that, they kept the interest rates at zero forever. In fact, negative interest rates. So a lot of people went and borrowed money in Japan, right, at zero cost, and then came and invested in US stocks, so that created additional liquidity in the global system. Well, what happened is that in April of 2024 is that now the Japanese bond rates started spiking. And the Japanese government, Japanese Federal Reserve, the JGB, they raise rates automatically because they don't want to now get from a deflationary cycle to an inflationary cycle. That's as simple as I can explain it. So when that happened, the Japanese yen started gaining value against the US dollar. So that's the problem. That's when the problem showed up. So there is two parts of the carry trade. Well, I go borrow in yen, okay? And when I do close this trade, I have to convert those yen into dollars. I cannot bring dollars back to the US if I'm a US hedge fund or any other global hedge fund. I have to transact in my currency. There is a currency exchange that has to happen. Well, if the currency relatively stays stable, that carry trade will work as long as it does. But when the Japanese yen starts gaining value against your currency, yes, you borrowed at zero and invested at 5, but then, and you have the leverage, obviously, but then when the Japanese yen starts gaining value against your currency, now you have the currency risk. Now you have to unwind all this before you lose your shirt, right? That's what happened last August, August of 2024. What's happening now, as of today, for the I don't know, for the past 6 months or so. Actually, I talked to my members group a few times. Do we have part two of Japanese yen carry trade? Well, what's happening now is that the JGB is the long-term bonds, Japanese government bonds, it's called JGB rates, have been skyrocketing. Why is that happening? Because their debt is out of control now. It's just like we are. We have 38 trillion in national debt. Japanese debt is also out of control. While the bond vigilantes or the people who trade bonds, they're going like, okay, inflation, they went from a deep deflationary cycle to now an inflationary cycle in Japan, and the bond market rates have been skyrocketing in Japan. Well, let's see if we can do a Japanese yen carry trade now, right? So the 10-year bond, 10-year note in Japan is about 1.87. That was zero. Well, now if I'm going to do a carry trade, I have to go borrow at 1.87%, but then the US rates are about to come down, right? Although they have not, they're, the Trump administration would like interest rates to be lower. Well, that's not happening either. So what's happening now is that we have skyrocketing rates in 10, 20, 30-year bonds in Japan. That is actually that is actually draining liquidity out of the system, because if I were to do a carry trade now, I can't. Because look at the difference in the Japanese 10-year note versus ours. Look at the difference in the 20-year bond versus ours. Look at the difference in the 30-year bond versus ours. The Japan interest rates have been spiking, like going through the roof, actually, and they're almost catching up to ours. So now what has happened is that, the question goes with the, like, how does it affect crypto? It affects crypto. It is no liquidity. And when the rates are going up like that in Japan, right, there are a lot of banks who hold their own bonds that are carrying billions in unrealized losses. So now the point in all of this is, in fact, Kobe's letter had a good tweet, and then I'm going to take a look at that and read you guys that. What the carry trade was, the liquidity pump of the globe, especially on a levered basis. Well, that liquidity pump has stopped now, because they were borrowing in Japan and coming buying US stocks, indexes, Nvidias, whatever they were buying, or bonds. Well, that has stopped. So now, if you look at the TLT today, which is the 10-year inverse index in the US, it's tanking. Why is it tanking? Well, Japan is the #1 holder of US Treasuries. Now, because their rates are skyrocketing, are they going to be forced? In fact, they have been sellers. China has been the second one. China used to be the top US Treasury bond holder. They have been liquidating and shifting into gold and going away from dollar-denominated assets. Well, now what? Now, today, our 20-year note or 20-year bond rates are skyrocketing as well. Is that a hint that the Japanese government has to now sell US Treasuries? So this is all interconnected. But number one reason for crypto, for me, for it to tank overnight, was liquidity is gone. So a lot of this money was going into probably crypto as well with the carry trade. Well, the carry trade is not possible anymore. The fact that Japanese 10, 20, 30-year bond rates or note rates are almost as high or higher than ours. The only saving grace may be now we may become the creditor of the world, although our ass is on fire with our 38 trillion in debt, national debt. What can happen is that, as Powell indicated, QT is about to end. Well, the timing of this is obviously pretty coordinated, as you guys can tell, because the Japanese government may have to hike rates now. So if they hike rates, is the yen going to gain appreciably against the US dollar? And are we going to have the second carry trade crisis? I don't think it's going to happen that way. I think what's going to happen is that, first of all, the liquidity pump that existed in Japan stopped. There's no more carry trade. You can't do a carry trade when the Japanese rates are equal to your bond rates. Where are you going to go invest that money? And you're 10x levered, God forbid, currency exchange rates are also going to be affecting your trade. So not too many people are going to do it. Well, that liquidity is drained from the system, and that's why I think crypto is getting a sell-off. Obviously, there's a lot of leverage in the crypto system as well. People are getting liquidated overnight. But let me just read this small passage that I caught my eye this morning. So pressure on Japanese government bonds is surging. Kobeisi letter is pretty good. I follow them on Twitter. So open interest in the front month of Japan's 10-year government bond futures just hit 188,000 contracts, the highest since September 2024. The number of outstanding future contracts that are still active has surged 65,000 since June. So if open interest is going up and the bond rates are going up, that means the bond prices are going down. That means a lot of people are shorting the Japanese bonds. Well, think about it. If rates go up, what happened to bond prices? Bond prices go down. It's an inverse relationship. So a lot of people are going short the Japanese bonds because Japanese interest rates are shooting up. So since then, Japan's 10-year bond futures have declined 2.6%. So people who are shorting are making money. During the same period, 10-year government bond yield has risen 34 basis points to 1.81, the highest since June 2008. Rising open interest along with falling prices suggest a growing accumulation of short positions among investors. Japanese bond market is in trouble. It is in trouble, and what's happening is that it's just putting a noose on this leverage, and it's not only slowing down, but it's stopping it dead in its tracks for future Japanese yen carry trade potential. So, with all that said, when liquidity is not there, what happens? Markets go down. Even, there's no support for markets, really. Like, who's going to come buy the indexes without a Japanese yen carry trade? Well, but I highly recommend for you guys to go check online JGB rates, what has happened over the last year or so, on the 10-year, 20-year, and 30-year. Look at the way interest rates are going through the roof in Japan. So interest rates going higher in Japan is not happening because Japanese government wants it, because that's pretty bad. But Japanese inflation now is going out of control, and the bond markets see this. And our bond market today is tanking on the 20-year side. Why? That's because Japan is the largest holder of U.S. Treasuries, about 1.7 trillion. What if they're going to be forced to sell that? What if they need to defend? What if they need to defend the yen, right? So there is a lot going on. And a lot of people on X, a lot of these supposed gurus don't make the connection and think about it. Look, you can't day trade, obviously, looking at the JGB rates and thinking about the carry trade. But if you're a swing trader, if you're a position trader, specifically if you're an investor, you need to read these tea leaves and understand what could happen. I'm not saying it's going to happen, because I think the timing of us ending QT and probably going into QE, the timing of the Federal Reserve completely changing, becoming basically a White House entity, losing its independence, has a lot to do with this. So now, are we going to open the pumps and start pumping and printing? Well, we may have to, right? Because we need liquidity. We need liquidity in the system. And when liquidity gets drained, a little bit of a sell-off, it gets exacerbated because there's so much leverage in the system. So to understand the relationship is important, obviously. But can you trade off of it? Probably not. But the carry trade that happened in August of 2024 was completely related to the Japanese yen gaining on the US dollar, because the currency exchange were putting a lot of positions upside down. Well, this time, over the last maybe 4 or 5 months, the dollar has been gaining on the Japanese currency, but now the Japanese bond market may force the Japanese Treasury to raise rates